Opendoor Technologies, trading on the Nasdaq under the ticker OPEN, is currently priced at $6.95, marking a significant intraday surge of over 4.5%. The stock is showing incredible momentum, pushing towards its 52-week high with heavy trading volume. But while the ticker flashes green and the price chart paints a picture of aggressive buying, a starkly different story is being told by the very analysts paid to scrutinize this company. The consensus price target from Wall Street sits at a stunningly low $1.14, implying a catastrophic drop from its current levels. This chasm between the market's euphoric rally and the analysts' dire warnings isn't just a minor disagreement, it's a battle for the very soul of the company's valuation, forcing every investor to question what is truly real. Is this a revolutionary tech company finally hitting its stride, or a financially precarious enterprise caught in a speculative fever? The prevailing expectation, the narrative that has propelled Opendoor's recent surge, is that the company is at the vanguard of a real estate revolution. The iBuying model, using algorithms and vast sums of capital to make instant cash offers on homes, is sold as the future of property transactions, a seamless, frictionless experience for the consumer. Investors buying into this story see a tech platform, not just a home flipper. They see a company poised to capture a massive share of the multi-trillion-dollar residential real estate market, much like Amazon disrupted retail. This expectation is fueled by headlines celebrating a potential peak in interest rates and a stabilizing housing market, conditions that should, in theory, create a tailwind for Opendoor's business. Many retail traders, using platforms from established players like Fidelity and interactive brokers to newer app-based services like Robinhood and SoFi Invest, have piled into the stock, chasing this narrative and the explosive momentum that has seen Open stock climb over 250% in the last year alone. The belief is simple: if the macro environment for housing improves, Opendoor's profits will inevitably follow. However, the reality of Opendoor's situation presents a far more complex and perilous picture. This isn't just a tech company, it's a capital-intensive business balanced on the knife's edge of housing market volatility. The company's financial statements tell a story of staggering revenue figures that are consistently dwarfed by even larger costs and persistent net losses. While the second quarter of 2025 showed a year-over-year revenue increase and a narrowing of losses, the company is still deep in the red. The core challenge for the iBuying model has always been its thin margins. Opendoor has to price homes accurately enough to resell them for a profit after accounting for carrying costs, repairs, and transaction fees. A slight miscalculation or a minor dip in local housing prices can erase that margin entirely. This is the risk that the low analyst price targets are reflecting. They see a company with a high debt-to-equity ratio, negative earnings per share, and a business model that is fundamentally exposed to macroeconomic factors far beyond its control. The recent rally, therefore, looks less like a vote of confidence in the company's fundamentals and more like a speculative frenzy, possibly amplified by its inclusion in meme stock discussions and short squeezes. The daily stock movement has been nothing short of breathtaking. In recent sessions, we've witnessed trading volumes that are multiples of the daily average, indicating a massive influx of interest. Institutional activity has been mixed, but the dominant force appears to be retail sentiment, a powerful but notoriously fickle driver. The stock's reaction to the latest weak jobs report is a perfect example of this dynamic. The expectation is that a cooling labor market will force the Federal Reserve to cut interest rates, thereby lowering mortgage rates and stimulating housing demand. Opendoor stock soared on this news, a textbook macro play. Yet this overlooks the reality that a weak economy could also lead to lower home prices and reduced transaction volume, directly hurting Opendoor's bottom line. The market is pricing in the best-case scenario, lower rates, without fully accounting for the potential economic downturn that could accompany them. This disconnect is where savvy investors, using sophisticated tools on platforms like interactive brokers or researching with Fidelity's wealth management resources, can find an edge, looking past the headline reaction to the underlying risk. Whether you're making a quick trade on the Robinhood app or building a long-term position in a self-investing account, understanding this tension is critical. At its core, Opendoor Technologies operates as a direct-to-consumer home buyer and seller. A homeowner can go to Opendoor's website, enter their address, and receive a preliminary all-cash offer within minutes, contingent on a home assessment. The value proposition is the removal of uncertainty, the hassle of showings, and the lengthy closing process. Opendoor then performs light renovations and lists the home on the open market, aiming to sell it for more than its all-in acquisition cost. While the company has expanded into ancillary services like mortgage and title, the bulk of its success hinges on this core iBuying model. Past performance has been a roller coaster. The company saw massive growth during the pandemic-fueled housing boom when rapidly appreciating home values made it easy to turn a profit. But as interest rates began to climb aggressively in 2022 and 2023, the model was severely tested. The company was forced to write down the value of its inventory, leading to staggering losses and a collapse in its stock price to below $1. The recent recovery, while impressive, has only brought the stock back to a fraction of its former highs, and the fundamental vulnerabilities that were exposed during that downturn remain. This is the history that long-term investors must weigh against the recent speculative excitement. Looking to the future, the outlook for Opendoor is a study in contrast, a tale of two potential paths. One path, the one the bulls are betting on, sees a soft landing for the economy where interest rates fall, the housing market re-accelerates, and Opendoor leverages its technology and market position to finally achieve sustained profitability. In this scenario, Opendoor refines its pricing algorithms, expands its market share, and proves that the iBuying model is not just viable, but superior. Catalysts for this outlook include any data pointing to falling inflation, dovish signals from the Federal Reserve, or a stronger-than-expected spring buying season in the housing market. However, the alternative path is fraught with risk. A recession, even a mild one, could depress home prices and crush consumer confidence, leaving Opendoor with an inventory of homes that are declining in value. Competition from traditional real estate agents and other iBuyers like OfferPad remains fierce. Furthermore, the company's high debt load could become an albatross if profitability remains elusive and access to capital markets tightens. The single biggest risk is a repeat of the 2022-2023 housing correction, an event that the company barely survived. Investors must ask themselves if the potential reward of this disruptive model is worth the existential risk tied to the housing cycle. I want you to comment below with your take. Do you believe the Federal Reserve will cut interest rates before the end of this year, and how will it impact the real estate sector? In summary, the story of Opendoor Technologies is a dramatic clash between a compelling, futuristic expectation and a harsh, financially challenging reality. The current stock price reflects a wave of optimism, a bet that the worst is over for the housing market and that Opendoor is the ultimate beneficiary of the recovery. The daily chart is a testament to the power of this narrative in today's market, where platforms like SoFi and Robinhood have empowered a new generation of traders to act on these high-growth stories. But beneath the surface, the numbers tell a different story, one of consistent losses, high leverage, and a business model that is exquisitely sensitive to economic forces it cannot control. The analyst's grim price targets are not an oversight, they are a calculated assessment of this underlying risk. The reality is that Opendoor is not just a tech stock, it is a leverage bet on the direction of the U.S. housing market. While the dream of disrupting real estate is intoxicating, the financial realities remain sobering. The ultimate trajectory of the Tesla stock, the Apple stock, or the Nvidia stock may be driven by innovation and market dominance, but for Opendoor, the path forward is inextricably linked to the price of a suburban home, the cost of a 30-year mortgage, and the confidence of the American consumer. Whether you use Schwab Intelligent Portfolios for automated investing or manage your own individual brokerage account, the fundamental divergence between Opendoor's market price and its intrinsic value is a puzzle that demands deep and careful consideration.